Jared says we're a demand response aggregator. So I'm here today to talk to you a little bit about how you can get paid by participating in the market while supporting the net zero transition. So that's the theme of the talk today. The things that I'm going to cover is I'm going to cover some of the common demand response. I'd call them myths now because a lot of them are sort of old adages that I think are no longer true. So I'll cover off some of those. Take you through the specifics of what's involved in FCAS and particularly the specifics of what's involved with a demand site participating in the FCAS markets. We'll go through a little bit of the characteristics of FCAS itself and what the monetary values might look like. And I'll also take a bit of a forward-looking view of where we see the FCAS markets. And so like Jasper put a disclaimer on that our forward-looking view is our opinion. And partially based on past performance. So it's certainly by no means to be considered a forecast, but we'll give you what my opinion is. And yeah, hopefully leave it open for plenty of Q&A at the end. So I'll jump straight into it. So just first of all, a couple of definitions. Jasper covered very well in his presentation. Demand response is quite a broad term. And FCAS is really a subset of demand response. So demand response is anytime an electricity consumer or a customer changes their consumption profile in response, normally to a price signal of some description. FCAS is very much a specific subset of the demand response suite. And so, look, these are some of and I call them myths because I think over the course of the presentation, hopefully I'll dispel some of them. But some of the things that we commonly hear from customers is that the requirement of demand response, the duration is simply too long for the plant or the operation to tolerate. It's oftentimes considered a bit complex and risky to participate in. With regard to markets like FCAS, I've heard comments that it's not yet proven. A lot of people do consider that the FCAS markets are what big batteries do and what generators do. And we oftentimes hear stories of how demand response is going to cause disruption in the plant and potentially even equipment failures. So over the course of this presentation, I hope to address those concerns. So I'll jump right into it. What exactly is FCAS? We oftentimes hear FCAS referred to in very broad terms, and people make sweeping generalizations about it. But I did want to try and break it down a little bit for the audience here, so we've a bit of clarity. Today, I'm talking specifically about contingency FCAS. So the FCAS market is divided broadly into two categories, contingency FCAS and regulation FCAS. So the characteristics of both. Contingency FCAS is used by AEMO when something has gone wrong in the grid. So it's when a large generator is tripped or transmission tower or something has gone over, causing a lack of generation in the grid. It's been open to demand side participation since 2017. So it's actually quite a well-established demand response market to participate in. And one of the key characteristics of contingency FCAS is suppliers are paid based on availability. It is not a dispatch-based market like what traditional demand response markets might be. So the suppliers do get paid continually, regardless of whether there's been an event or not. On the other hand, regulation FCAS is a little bit different. Regulation FCAS is more the remit of generators. I would call it the cruise control for grid frequency. Some power systems engineers might question me on that, but it behaves essentially like cruise control. The speed of the grid, and I'm from a power systems background, the speed of a grid is 50 hertz. It's related to the speed of rotating mass, so it is directly correlated with speed. We try and keep it around 50 hertz. Minor fluctuations in load will cause that to move up and down, and that's what regulation FCAS does. And just for clarity's sake, we're not discussing regulation FCAS today. So I did think it's worth just making those clarifications because the characteristics and pricing and so forth, it really does depend on which specific FCAS market are you actually talking about here. And so just to reconfirm for people who may not be fully across it, how does contingency FCAS actually work on the demand side? So I've got a little bit of an oversimplified graphic here on the right-hand side. where we have the unexpected loss of a large power generator, and it might be a transmission tower. We saw that on the 13th of February. It was actually the transmission going over that caused a generator to trip, so it's sort of the other way around. Either way, you get a massive imbalance in the grid. And so AMO always need to have that contingency covered with spinning reserve, or what's the equivalent of spinning reserve. And so there's two mechanisms there. You can either rapidly increase generation output to make up for the loss, or you can rapidly deload the grid as well, which is essentially what the demand side is doing. You rapidly drop 3 megawatts of a cement mill, for example, and it's the same as if you ramped a generator by 3 megawatts. There's the same net effect on the grid. And so that's how demand response and contingency FCAS in effect works. I thought I might clarify what the role of an aggregator or a demand response service provider like ourselves is. This isn't a promotion of VIOTAS by any stretch. This is the same with any aggregator that's out there in the market. So what exactly do they do? An aggregator, typically for a demand site, an industrial or a large commercial customer, will have a piece of hardware that's monitoring grid frequency. And it's usually a relatively specialized piece of frequency monitoring kit. It's not your typical power meter, and there are some special characteristics you need for FCAS. And it is listening to the grid frequency at all times, because as Jasper said, this is not something that you pick up the phone and ask someone to do. This is an automated response. And so you have to be monitoring the grid frequency in real time. And you need to be able to accurately determine whether it actually is a grid frequency event or whether it's some other transient that might be happening on the grid, because the last thing you want is to be tripping customers out on a transient type event. So that asset will normally send then a dispatch command to whatever the particular load at the site happens to be. And bearing in mind these days, it might actually be behind the meter generation, because ramping up behind the meter generation is the same thing as reducing the load. It's whatever the net that's seen at the NIMI is what the actual response is. So typically it might be cement mills, it might be emergency backup systems and data centers, so online UPSs and so forth. Cold storage is a great one, and I know we've got Brendan online here, so I'm sure he'll talk a little bit about chillers and their response later on. And finally, the last function that the aggregator does is the aggregator takes on all the risk around the market compliance piece. So the demand site or the customer does not have any of that market participation risk. That's the job of the aggregator to do. And the complete financial settlement portion as well. So the bidding of the available assets, the enablement, and the follow through to final financial settlement and actual payment. So a company like ours will issue RCTIs to customers for full clearance of the money as well. So that's in essence the role that an aggregator plays in the whole thing. I wanted to cover a little bit around the FCAS key characteristics, and this is what I think will change people's minds around whether their site is suitable for demand response. And I think some of these characteristics, particularly since the introduction of the very fast R1 market, which Jasper mentioned in his presentation as well, really does change, I hope, the way people view demand response. We're going to have a look at the prices later on, but I can confirm the bulk of FCAS revenue now does sit in the R1 market. AMO is after faster and faster responses. As we move towards a more lower inertia-based grid, this service gets valued more, and the value dwindles in the slower services. Now, the reason that's relevant for a demand type site is it would actually be a valid trading strategy if you had a load that was capable of the 1 second response, and we'll go into that in a second. Your maximum response duration is actually only 6 seconds to access the revenue in that market. And that very much fundamentally changes how you would look at the disruption on a plant, because all of a sudden you're not talking about hours in the afternoon of an outage. You're talking a very, very short duration. And in a site process that might have a bit of inertia behind it, there may actually be no interruption to plant at all if it's done accurately. And so the other services still remain. So we've got the R6, R60, and R5. But what we will see later on is the slower markets, the value has dropped away. So what we're seeing is very much a shift of the revenue towards those faster and frankly more difficult markets to perform in. But I'll cover how we do that later on. For those of you that might be interested, the frequency of these events, so how often will they actually happen? It varies, but it's on a yearly basis, it's somewhere between 6 to 12 events over the course of the year. They're not events that can be forecasted by the very nature of them. They're contingency events. So who can tell when a transmission tower is going to actually blow over? Very difficult to forecast, but the response is automated by the metering equipment that I talked about earlier that goes on site to do that response. I should point out at this stage within our team, we all come from an engineering. I myself come from a controls background. So we're well used to getting on site and having a look at an assets control scheme and working out how we can best integrate with that and isolate specific loads. So we're not in the business of taking out a whole site. We're much more laser focused in that, where a specific subload on a site can be taken out. Particularly ones like, if you think of refrigeration plant, typically the biggest portion of a refrigeration plant is going to be its compressor. We can get in there and isolate just the compressor and let it coast for a period of time while leaving the lube pumps and all the other portions of the plant online, remaining connected to the power, and just isolate that for the short duration response and then bring it back on again. And that's a very viable way of participating in this market. So I think from a VIOTAS perspective, it's an important part of the business that we do, is actually understanding the customer's assets in their plant and the characteristics of them, so that we can get something that is going to function well in the market, but not interrupt plant too much either. So what types of loads are typically suitable for FCAS? I've covered some of them already. So in the mining and quarrying side of things, big motors, fans, mills are particularly good. So a lot of our customer base so far has been large cement mills, typically secondary mills. So where the big rocks have already been broken down a little bit, the secondary mills can start back up under load without needing to be cleared out or anything like that. So that's, like I said, that's part of what we do, is to look into different assets and see what the actual requirements of each individual ones and which are going to be suitable for participation or not. Within data centers, it's usually the emergency backup. So data centers do not want to drop load, and that's not what we do when we look at the data centers. Data centers luckily have typically online backup systems, so that if there is a grid failure, there's a bumper transfer of IT load, and we leverage that to perform in the market. Cold storage, I mentioned already. I don't want to talk too much about cold storage with an expert like Brendan on the line, because it's process plant is not my area of expertise, but I'm sure Brendan can answer anything on that. And then other types of assets, wastewater treatment, large pump sets, that sort of thing, irrigation pumps. Essentially anything that's relatively flat and predictable. If it runs to a schedule, it's automated, it can probably be considered, as opposed to anything that might be manually controlled. If it's manually controlled, it's harder to predict, it's harder to bid into the market. Unfortunately, human beings, we haven't figured out a good way of what they're going to do from 1 minute to the next still. So until that day, it's probably more your scheduled and automated assets that suit. I've got down here as well, typically assets that are greater than 500 kilowatts. That's more of an economics thing. You've got to consider the business case of you're going to have to do some testing, some installation of equipment to participate. The equipment costs money, the installation costs money, and the customer and the aggregator, the economic benefits need to be there. And currently, we've found that sits roughly around the 500 kilowatts. Anything greater than that, we can typically work with. So market trends, I did say I would look at market trends and pricing. And so what we're looking at on here is the O&S market was introduced in October 2023. The O&S market is the darker brown color that you can see on there. And the orange shades are call them the legacy markets. And so what you can see is a very sharp decline in value in what I'd call the legacy markets. They're not gone by any stretch, but they're the existing markets. But you can see the revenue is completely dominated now by the new O&S market. And so going back to what I was talking about earlier, it's a valid trading strategy for a demand side now to say, hey, I might just pop in for O1S. I know I'm going to limit my outage for a maximum of 6 seconds. And in doing that, I'm going to pick up well over 90% of the revenue. And so contrary to what people have been talking about, that batteries will push the FCAS price down, it's more that it's shifting the value. It's shifting the value into the faster markets. The more slower legacy markets, yes, the value is dropping, but the increased revenue seen from the O1S market has more than compensated for that, as you can see. So, the month of January, the average FCAS price across the 4 markets was 35 grand per megawatt hour. Or sorry, per megawatt month, I should say. Beg your pardon. These are in the unit of megawatt months. So just to kind of put some backup and proof around what I was saying earlier around demand response capabilities and ability to compete with batteries as well in the FCAS markets, I think FCAS became a common discussion point when, I guess, the Tesla battery was built in South Australia, and everyone became aware of the revenues that were involved at the time. And I think the perception that only big batteries can access that kind of revenue probably still stuck around, because those guys certainly do good marketing around what they do. What I wanted to do here is just point out 2 particular participants on this list. So there's ourselves and our friends at Enelex, both demand response participants. And you can see on this graph from Q1 2023, by volume participating in the O1S market, ourselves and Enelex did a good job of competing with the batteries in terms of the actual volumes. So that means customers of VIOTAS and customers of people like Enelex were receiving equivalent revenues to what the big batteries were actually receiving for the same period. Now, I should qualify what I'm saying here by stating that the O1S market still is in a capped condition. So it started off when it was introduced at 50 megawatts. It's now capped at 225 megawatts. The underlying demand is actually much higher than that. It's currently capped because supply is limited, and if the cap was lifted, the price would go to market cap quite quickly. And so it's still currently capped. The reason for that is demand is strong for the service, but supply is still sort of thereabouts. It's limited at the moment, as you can see from the list of participants. Big batteries and demand response with the right power metering and control capabilities are the only assets that can actually participate. You're not seeing thermal plant participating, and that's down to the mechanical limitations of the rotating equipment. They just simply can't respond quick enough to participate in the market. Now, what that means from a pricing perspective is what we've seen happen with the O1 price. In our opinion, that trend will continue, that we'll just see very high O1S prices, and probably the remainder of the markets stay quite low. But overall, the FCAS pricing will remain strong in aggregate across them. The other thing I wanted to say about big batteries is we've seen a number of comments out there that big batteries will force the FCAS price down, and that's not entirely true. That's a slight mischaracterization of the market. And I've just picked out this one example, which I quite like, and there's other things I'll talk about on this subject as well. But one of the things I wanted to point out is this is actually the bid stack. This is going back to January. This is the bid stack of everyone providing O1S. And you can see here the salmon color. That's actually Torrens Island Power Station and how they're bidding into the market and their capacity. But what you'll notice right over here, right around midnight, is the salmon disappeared from the bid stack and everything dropped down. And correspondingly, the price in the market at exactly the same time, if you see midnight right here, hopefully everyone can see my cursor on the graphic on the right, the price shot up. And so what I'm getting to here is batteries, and big batteries particularly, actually become not a contingency, but a driver of high prices. So if a battery has to pull out of the market, and there can be many reasons why they would do that. One of the ones that springs to mind is the spread opportunities that Jasper had on his chart. Those spreads opportunities for battery are increasing rapidly. If I saw a spread opportunity like that coming up and I was operating a battery, I would pull all my capacity from FCAS and I'd put it into energy because we can't have the same megawatt in multiple markets. You just can't do that. And so a megawatt in FCAS is not a megawatt in energy, for example. But also there can be maintenance issues. There can be all sorts of reasons why a battery might come offline and cause this effect in the pricing as well. So I thought that's interesting to note. And then the other thing is, because we've got an energy-only market, the only way that the market operator can encourage participation is by the price. And so clearly, if the price dwindles away, batteries will no longer provide the service. There's a value isn't there. They can get more value in other markets. And so what you'll end up with is the market will return to an equilibrium price that batteries can actually tolerate. And against the common myth again, battery operators, in my opinion, are out there to make money. They're not altruistic folk who want to drive the energy prices into the ground and leave it there. That's not the business that they actually operate in. Batteries cost money in capital to build and also to operate, and that money needs to be recouped in the market. So those would be my comments on the future of FCAS pricing and the reasoning behind it. So I just wanted to summarize a couple of key takeaways, and hopefully I'll have left enough time for questions afterwards. So hopefully I've got across in that slide deck that the FCAS market is very different to what a lot of people picture as traditional demand response. And hopefully people are reevaluating their opinions that way. FCAS is highly lucrative and accessible to industrial and large commercial customers. There's no doubt about that. Again, in my opinion, the prices in the faster FCAS markets are likely to remain high, and it's due to restricted supply and high demand levels. Economics takes over, and the price there should stay relatively high going forward. The FCAS or contingency FCAS markets, and particularly now with the R1S come in, it involves only very short and infrequent disruptions that oftentimes can actually be managed on site without any significant plant disruption at all. And like I said, aggregators like ourselves, VIOTAS, we're used to doing the engineering involved to get in on site and understand how the plant actually operates and what loads can and can't participate accordingly. I've shown that demand response sites actually delivered a significant portion of the new R1S volume in the last quarter, as in last year. That doesn't get talked about a whole lot. I don't know, the news seems to talk about batteries for whatever reason a lot, but demand response is right in there at an equivalent level. And finally, the demand response participating in FCAS, it is well proven. It's been around for many years now. And any market risks for the customer in participating, those sit with the aggregator. Just to be clear on that, that's not a risk that the customer site themselves wears. So that's it from me. Jared, I'll leave it open to questions.
Brilliant.